ETF versus mutual fund. When it comes to popular diversified investment options, most investors prefer to invest in exchange-traded funds, ETFs, or mutual funds. ETFs and mutual funds are essentially two sides of the same coin, offering options and flexibilities to investors. Both funds share some important features that can serve investors well. Each allows diversification by bringing together dozens, sometimes hundreds, or even thousands of individual stocks or bonds, or both, into a single offering. But which makes a better investment? Exchange-traded funds, ETFs, or mutual funds? In this episode, you will learn what are exchange-traded funds, ETFs, what are mutual funds, reasons to invest in ETFs over mutual funds, plus one trivia question about ETFs. Today's trivia question is, who invented the first US ETF? We've also included the timestamps in the description below if you want to revisit any particular section of the video. Before we go too far, let's quickly see the differences between ETFs and mutual funds. What are exchange-traded funds, ETFs? An exchange-traded fund, ETF, is an investment vehicle, a hybrid of mutual funds and closed-end funds. ETFs hold a basket of assets such as stocks, bonds, or commodities, and trade on a market exchange so they can be traded anytime stocks trade. A well-known example is the SPDR S&P 500 ETF, SPY, which tracks the S&P 500 index. ETFs can contain many types of investments, including stocks, commodities, bonds, or a mixture of investment types. An exchange-traded fund is a marketable security, meaning it has an associated price that allows it to be easily bought and sold. Real-world examples of ETFs include SPDR S&P 500 SPY. The oldest surviving and most widely known ETF tracks the S&P 500 index. iShares Russell 2000 IWM tracks the Russell 2000 Small Cap Index. Invesco QQQ indexes the Nasdaq 100, which typically contains technology stocks. SPDR Dow Jones Industrial Average DIA represents the 30 stocks of the Dow Jones Industrial Average. Sector ETFs track individual industries such as oil, OIH, energy, XLE, financial services, XLF, REITs, RYR, biotech, BBH. Commodity ETFs represent commodity markets including crude oil, USO, and natural gas, UNG. Physically backed ETFs, the SPDR Gold Shares, GLD, and iShares Silver Trust, SLV, hold physical gold and silver bullion in the fund. What are mutual funds? A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. In other words, a mutual fund is a type of fund that seeks to track the returns of a market index. The S&P 500 index, the Russell 2000 index, and the Wilshire 5000 Total Market Index are just a few examples of market indexes that index mutual funds may seek to track. If you're still unsure what a mutual fund means and how it works, make sure you hit that subscribe button and stay tuned for our future episode covering that topic in detail. Now you know the differences between these two funds, so why should you prefer exchange-traded funds over index mutual funds? 8 reasons to invest in ETFs over index mutual funds. 1. Investment flexibility. This is one of the unique features of exchange-traded funds. Unlike mutual funds, ETFs can be traded throughout the day at exchange just like stocks. You can simply buy or sell ETF shares through your broker. ETF system allows traders to trade ETF shares for a short term and make decent profit. Stock trading involves concentrated risk, but ETFs trading remove concentrated risk since it's a basket of stocks or any other security. Hence the risk gets diversified. 2. Transaction flexibility. No matter what trading strategy you develop, you will find ETFs to execute the strategy with ease. No matter if you want to invest in real estate, corn, oil, or an index, or just run a market rotation strategy, you will find a broad choice of ETF to help you to execute the trading strategy without the need of doing further research on the trading instruments. 3. Lower expense ratios. Cost efficiency is another great feature of ETF funds, which can boost your investment performance. Unlike index mutual funds, ETFs do not charge exit load fees and other management fees. Since ETFs are traded on the exchange, they are subjected to brokerage charges, which are variable depending upon the brokerage firm, but low in cost compared to mutual funds. It's been said that the average management fees of the US Large Cap Mutual Fund are almost 3 times the average management fees in the US Large Cap Equity Fund. Also, ETF expense ratio is less than the mutual fund. Less ETF charges adds more value to your investment. Considering all the aspects, ETF investing is more beneficial rather than the mutual fund investing in terms of cost efficiency. 4. Tax advantages. In mutual funds, when a shareholder cashes out, the fund has to sell securities to fund the liquidation. This is a taxable event with a capital gain or loss. Even when a mutual fund drops in value during the year, shareholders still have a tax liability. On the other hand, the structure of ETFs allows shares to be created and liquidated without selling securities, thus preventing an additional capital gain loss. 5. Portfolio diversification. ETF investing allows investors to invest in the broad market. ETF enables access to many markets like index, commodity, industry sectors, and bond markets. When you invest in a piece of ETF share, it means you're investing in broad index such as S&P 500, e.g. SPY, IVV, VOO, DAX, e.g. XDAX, iShares Core, DAX, UCITS, ETF, iShares MSCI, Germany ETF, WisdomTree Germany Hedged Equity ETF, FTSE, e.g. FEUZ, FEP, EZU. ETF not only invests in stocks index, it also invests in commodities, currencies, and bond index, hence it is the best way to diversify your investment. 6. Transferability of ETFs. Whenever an investor moves a managed portfolio to a different investment firm, complications can arise with mutual funds. Oftentimes, the fund positions have to be closed out before a transfer can take place. That can be a major headache for investors who are forced to make unwanted or untimely trades that could result in losses. With ETFs, the transfer is clean and simple when switching investment firms. They are considered a portable investment, which offers a nice advantage over mutual funds. 7. Transparency. For an investor, transparency simply means access to information about the fund manager or the company's stocks and other securities in which the fund manager is investing. Normally, mutual funds and other investment funds publish their fund holdings with a time lag. Therefore, an investor is always unaware of current or updated holdings of funds, but ETF funds publish their holdings on a daily basis, which helps the investor to take a quick decision on investment. Also, exchange-traded funds are traded on an exchange throughout the day, which allows investors to see ETF daily performance and updated NAV, net asset value, unlike mutual funds who disclose their NAV at the end of the day. 8. No minimum purchase. Another reason to consider exchange-traded funds over mutual funds is that ETFs don't have any minimum purchase. Unlike ETFs, mutual fund sponsors are required to make a minimum purchase of anything between $100 to $3,000. In fact, some mutual fund sponsors require as much as $50,000 to get started. There are many advantages to including ETFs in your investment portfolio. While mutual funds, equities, derivatives, and indexes are all solid investments, ETFs are a financial weapon that should be part of your investing arsenal. As with any investment, you should thoroughly research any ETF before committing your money to it. Conduct your due diligence, include monitoring how the fund performs under different market conditions, and taking a look at the assets held in the fund. If you have any questions or concerns, make sure you consult a financial advisor or another financial industry professional. So, back to our trivia question for today. Who invented the first US ETF? Nathan Nate Most invented the first US exchange-traded fund and spawned a growing $190 billion industry. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck, and see you in the next episode.